So we got the first 5 chapters behind us now, and so we move on to chapter 6, which is the finance chapter. Money. Obviously, y'all, this is going to be a big part of any real estate transaction. Financing. Going to play a big role. So we need to, there are obviously some things we need to understand about financing, how money works to some degree. Now, before we get into the meat here, a couple things I want to make sure you kind of understand and make sure you understand this for test purposes as well. Again, keep in mind the role you're playing in the real estate transaction. You're the agent. You're the real estate agent, right? You're not the lender. You're not the loan officer. And I know this is going to sound a little bit kind of contrary, I guess, but there are just things you need to understand about different types of loans. In fact, you need to understand or be able to differentiate from one loan to another loan. And I will tell you, throughout this chapter, we're going to be talking about quite a few different types of loans. And you need to know the difference from one loan to another. In fact, I'll just tell you, when they're asking questions about financing, in particular to the types of loans, they're not going to ask you things typically. They're not going to say, well, what is an open-end mortgage? They're probably not going to be asking you questions that way. Rather, they're going to say, John Doe is buying a house for $200,000. He put this much money down, had required this much down payment, did this, did that, and whatever. And then, based on that information, now you should be able to figure out what type of loan is that. If he had to do this, this, and this, then that should identify the type of financing we're dealing with here. So that's why it's going to be important to really understand the different types of financing. Probably easier if they just give you a type of financing and you just give them the definition. But you got to understand how it works. Now, having said all that, again, going back to what I kind of started with, don't get outside your lane here. Should you as the real estate agent ever recommend or suggest what type of loan the buyer should get? No, y'all don't do that. Y'all stay in your lane. Even though you may have knowledge, and hopefully you do, that's what will make you a good agent. But hopefully you have enough knowledge that you're thinking, you know what? Given what the buyer's goals and objectives are for this particular property, I think this type of loan would be the best situation for them. But the lender's trying to put them in a different type of loan. What do you do about that? Well, again, you don't ever say you need to tell them you want this loan. You don't want to be that person. I'm just telling you. Things can cause you some problems and potentially some legal problems, when you're operating outside of your lane. A question I get all the time. People will ask me, well, Frankie, if I can't give advice or suggest what my client might want to do, why do I need to know this stuff? What's the point? Well, one, because it's on the exam, so you got to know it. But no, look, there's a difference here, and might be somewhat of a thin line that you want to be careful with. But what I like to do, and what I do, when I'm working with a buyer, and I feel like there might be a better type of loan or situation for the buyer, obviously I'm not going to tell them what they should do or consider doing. I won't go there. But what I will do is this. I will give the buyer some questions they need to ask their lender. I'll just say, you know what, you might want to find out about this. Ask them about this. Or ask them to compare this to this and see where the numbers work out. And So, I'm arming my buyer with information, questions that they can now go get the answers for themselves and then make the decision for themselves. I had nothing to do with that decision-making process other than to suggest what questions you might want to ask. I'm in no way trying to say this is what you should or shouldn't do. Okay? So just keep that in mind as we go through. So again, a lot of stuff you got to know, a lot of stuff you got to understand. But be careful how you use that information when you're practicing real estate. Stay in your lane. That's the main thing. So what are we going to be dealing with here? Well, you see some of the topics that we're going to be discussing. We're going to start out just talking about just some of the general concepts about real estate or financing. The types of loans, and y'all, and I promise you it's going to seem like a lot of loans we're going to be talking about. But just know, y'all, this really doesn't even scratch the surface when it comes to all the loans that are actually out there. So we're just going to be hitting on quite a few of the major, more popular type loans, I guess we might say. But then, y'all, you see some of the things we're going to be talking about there, and we'll get through them. Y'all, last thing I will just say before we get into these concepts, y'all, there's probably 2 or 3 chapters throughout the course required to get you licensed that I noticed that most people have the most problems with. There's always got to be that 1 or 2 chapters that tends to create the most problems. Doesn't mean it's going to make you fail, or I'm not trying to suggest that. But I am saying there's always that 1 or 2 chapters that for some reason more students have problems with than others. And I will tell you, this is one of them. Y'all, this is one of those chapters that I would probably spend a little bit more time making sure you understand some of this stuff. Okie dokie. All right. So let's get started. Under some general concepts, just things we need to understand about financing in general. Y'all, the first thing we look at is this loan to value ratio, or LTV, you'll hear it referred to as a lot. Y'all, the LTV is, it's a number expressed as a percentage. But basically what this percentage is telling you, whatever the LTV is, y'all, that's how much the bank or lender is willing to loan you, or what percentage of the purchase price the bank would be willing to loan you. Y'all, for example, you might hear a lender say, all right, you're approved up to $100,000 with a 90% LTV. Okay, well then what does that mean? Well, that means that you're approved up to $100,000. That's the most they're going to loan you. But the loan to value is going to be 90%. So the purchase price, say it's $100,000, they're only going to loan you 90% of that purchase price. Purchase price is $100,000. They're only going to loan you $90,000. Well, wait a minute. What about the other $10,000 I still have to pay the seller? You're going to have to pay that out of pocket, right? So the loan to value tells you how much the lender will loan you, or what percentage of the purchase price they're willing to loan. Just know the difference, that's going to be your down payment. You got to pay that out of pocket. Now, depending on the type of loan you decide to go with, will have a lot to do, or pretty much everything to do, with what that loan to value ratio will be. Now, you see the 3 most common types of loans here. We go ahead and kind of give you what that loan to value ratio will be, and I will tell you, you need to know this. You need to know these loan to value ratios, certainly for these 3 loans. If it's an FHA loan, you're looking at a 96.5% LTV, meaning you're going to have to put 3.5% down. VA is 100%, meaning there's no down payment. Now, I'm going to tell you that can be a little bit misleading, and you'll see why I say that when we get into actually going over VA loans. But for now, y'all, VA loans offer 100% financing. And then there's the conventional loan, and the loan to value for loan to value for conventional is 80%, which means you would have to put 20% down. I know some of you thinking, well, that's not always the case. Well, just hold your fire there. Y'all, we're going to break this down a little bit more and explain why these are what they are. But y'all, you need to know this for test purposes. Okay? Y'all, for example, they might just ask you or say, John's buying a house, purchase price is $200,000. He's seeking a FHA loan, and he's paying $5,000 in closing costs. What's his total out-of-pocket expenses at closing? Well, you already know they said $5,000 in closing costs, so that's part of it. But what's the down payment? Well, they told you it's an FHA loan, and the purchase price is $200,000. Then, y'all, if you know FHA requires 3.5% down, then you should be able to figure out what the down payment will be. Add that to the $5,000 closing cost, and voila. Okay, so I just want to make sure you understand how they're going to be asking these questions and why it's so important. This is like a memory item. You got to know what these ratios are. Okay, moving on. Discount points. We touched on these a little bit in an earlier chapter, if you recall, when we were talking about taxes. But, discount points obviously deal with financing. And this is the way you can actually buy down your interest rate. You can, you buy discount points, that lowers your interest rate. And if you recall, how much does each point cost? And each point will cost 1% of the loan amount. That's what it costs. So if it's 1 point, then it'd be 1%. If you're buying 5 points, then it'd be 5%, again, of the loan amount. Where you've got to be careful here for test purposes. This percentage, if they're asking you how much a discount point costs, it's always based on the loan amount, not the purchase price. So again, if they tell you, they may give you a question. John's buying a $200,000 home using FHA financing, wanting to buy, and he's buying 2 discount points. Then how much will those points cost? Well, first of all, now you got to figure out what's the loan amount. Well, we know FHA is 96.5% of, in this example, $200,000. So you have to do some math to figure out what the loan amount's going to be, and then you'll multiply the 2% for 2 points to figure out what the cost of it is. If you use the purchase price, I promise you that will be one of your answers. And you're going to feel really good about coming up with the same wrong answer they did. But at the end of the day, it's still a wrong answer. So just be careful about, you got to pay attention to these questions. All right. So we know how much they cost. Well, how much will each point lower my interest rate? And you see here, it will lower your rate by 1/8 of 1%. Each point will lower the interest rate by 1/8 of 1%. So obviously, if you bought 2 points, then that would drop your interest rate by 1/4. And that's how that works. But you do need to know how much they cost and how much each point will lower the interest rate. Okay. Now, just as a review, the reason we were talking about discount points in an earlier chapter, in fact, we were talking about when we were going over tax, some of the tax advantages with real estate. Remember, first of all, what is a discount point? It's just prepaid interest. That's all it is. You're paying X amount of interest up front. So in return, the lender agrees to reduce what the interest rate would be. But what is it? It's just prepaid interest. Well, is interest, y'all, mortgage interest, is that tax deductible for tax purposes at the end of the year? Yes, it is. You can deduct that for tax purposes, but if you recall, y'all, only the buyer can deduct discount points for tax purposes. Y'all, even if the seller agrees to pay for the points for the buyer, which is very common, doesn't matter who pays for it. Only the buyer can deduct it. So that is a nice thing for the buyer. Y'all, if the seller paid $4,000 in discount points to lower my interest rate, so I'm not having to pay it, and I get to write it off as a tax deduction on top of it. That's sweet if you're the buyer. All right. So, moving on. Y'all, the next thing we look at is this origination fee. And y'all, this is just a fee that the lender charges to put the loan together. It's usually some percentage, again, of the loan amount. And y'all, this might be something you'd want to talk to the lender about. I say you, the buyer, y'all, because this will be part of the cost of borrowing money. They will charge some percentage of the loan amount, and they just got an origination fee. Y'all, it's just what they charge to put the loan together. That's all that is. Now we look at this mortgage broker commission. Well, first of all, let's talk about mortgage brokers. Y'all, is there a difference between a mortgage broker and a lender? Yes. Y'all, do mortgage brokers loan money? No. Lenders loan money. Y'all, mortgage brokers don't loan money. But so what does a mortgage broker do? Because y'all, a lot of people use mortgage brokers, and I'm not trying to suggest there's anything wrong with that. Just need to understand what you're doing and maybe why you're doing it. But y'all, a mortgage broker does not loan you money. Y'all, if you go to them to try to get a loan, they're not the ones going to be loaning you money. What the mortgage broker will do, they will contact a lender or maybe several lenders and basically try to broker a finance deal on your behalf. They're in essence trying to get the best loan for you. Y'all, that's what a mortgage broker's doing. Just know that they're not the ones actually making the loan. They're negotiating the loan on your behalf with some lender. That's what they do. So if they're not making the loan, then how does a mortgage broker get paid? Y'all, they charge an origination fee. Y'all, again, this origination fee, it's usually some percentage of whatever the actual loan amount would be. And that percentage could vary. Y'all, there is no set amount here. Y'all, so it can vary. But what you tend to see, or might be kind of typical or common, y'all, and as you see here, y'all, don't be surprised if it's anywhere from 1%, maybe even 3%. Y'all, it could go higher than that. It may not even be might be less than 1%. So I'm not trying to set any parameters here. I'm just trying to give you an idea of what this fee might cost, okay? So y'all, say it was a 2% origination fee and you're getting a $300,000 loan, then obviously 2% of 300, that's going to be what, $6,000 that you're going to pay that mortgage broker to help you get this loan, okay? Now, y'all, some questions that I tend to get quite a bit is, well, then does it make sense to use a mortgage broker? Y'all, could you just go straight to the lender and get the loan yourself without using a mortgage broker? Absolutely you can. Well, if I don't use a mortgage broker, didn't I just save, again in this example, didn't I just save $6,000 by not having to pay the mortgage broker? Well, it depends on how you look at it, but potentially. But I will also tell you the lender is probably going to be charging an origination fee as well. So I don't know, y'all, obviously you'd have to do the numbers and see how that works out. But here's what I want to really make sure you understand here. Y'all, I've actually listened to some real estate agents actually tell buyers, their clients, don't use a mortgage broker. You're going to be paying them a lot of money for something that you could do yourself. You don't have to go to them. Just go straight to a lender. Y'all call Bank of America or whoever, whatever loan. I don't even know why I said Bank of America. It's just there's millions of them. Go to a lender and just tell them you want a loan, and then you don't have to pay this mortgage broker's origination fee or commission. I don't like that. I don't like that because I will tell you, look, if that makes sense to you, why would anybody wanting to sell their house hire a real estate agent? Why don't they just do it themselves? Can they sell the house on their own? Yeah, it's called for sale by owner. So if that makes any sense, what you just said about that mortgage broker, then why wouldn't that apply to real estate agents? Just do it yourself. You know how much commission you're going to save by not having to pay a real estate agent's commission? A lot of money. So just do it yourself. Well, if that's the case, then why do so many people still hire real estate agents? And there's actually a good answer and a good reason for it. Because most people don't know how to sell their house. And even if they did know how, they probably don't know how to price it. There's a reason you're hiring a professional, because they know what they're doing and you don't. And I would say the same thing for mortgage brokers. Now this is my opinion. I'm entitled to it, so I'll share it with you real quick. But if you personally know a lender, a loan officer that works with a lending institution, you personally know them, you trust them, that they're going to do things that's going to be in your interest, not the lender's interest. They're going to try to put you in the right loan for your situation. It means you know them and you trust that they're going to do that, then by all means, go straight to the lender. But if you don't know somebody, and I mean personally, there's got to be a lot of trust here. I don't care how nice and wonderful they sound over the phone or maybe even in person when you first meet them. If you don't know them, you don't know what they'll do. I'm just telling you that right now. I've been doing this for too long. And lenders do not owe you any fiduciary services or responsibilities. And it's just been my experience that these lenders are going to try to sell you the loan that makes the most money for the lender and or for the loan officer. And that might not be the right type of loan for what this buyer's trying to do. That really irritates me, quite frankly, but the laws are what they are. You better know that lender or loan officer. If you don't, then I would suggest you get a mortgage broker, and quite frankly, it'd be nice to be able to trust them too. But I would trust a mortgage broker to help me get a better deal than just going straight through the lender if I don't know them. I might have to pay that mortgage broker or something up front or maybe at closing. But if you got a good mortgage broker, they're going to save you way more over the course of that loan. I mean, way more. It could be tens and tens of thousands of dollars. It's just it matters on how the loan, first of all, it matters on what type of loan and how it's put together. Most people don't understand any of this stuff, and we're not going to get into the weeds too much either in here. But a mortgage, that's their business. They know. So they know how to put the loan together that will save you money over the long run. And when I say save money, it'll be way more than what you're actually paying them. Just like same reason most people, when they go to sell their house, hire a real estate agent. Statistics have proven year after year after year that the homeowners that hire or pay a real estate agent to sell their house, the the percentages of them netting more money, even though they had to pay out a commission, they still make more money at closing than they would if they tried to do it themselves. Y'all, the statistics prove that year after year after year. Y'all, I mean, forever. And again, because hopefully when you get your license, y'all, you know what you're doing. The seller doesn't. And quite frankly, the buyer doesn't either. They may think they do, but y'all, until you've been educated and trained in a certain area, y'all, you never know what it is you don't know. And that one thing you did not know can come back and hurt you, and it could be very expensive. So anyway, y'all, I won't prolong that no more. So you know how mortgage brokers get paid. Y'all, next concept we need to take a look at is this private mortgage insurance, or you hear it referred to a lot as PMI. And this is pretty much exactly what it sounds like. Y'all, it's mortgage insurance. Y'all, this is insurance to protect the lender. Y'all, if the buyer defaults, they quit making their payments, well, assuming we have mortgage insurance, that means the mortgage insurance company will pay off the unpaid balance to the lender. So at least the lender still gets their money even though the buyer quit paying and defaulted. So if you're the buyer and you had that insurance and it pays it off, are you in the clear now? No. You still owe the money, it's just now you owe it to the insurance company. Now the insurance company is the one going to be dealing with you, y'all, if you have mortgage insurance. Y'all, so for one, I just want to make sure you understand what this mortgage insurance is. And now how and when does this apply? Well, y'all, if you recall, we were talking about the loan to value ratio, y'all, the LTVs. Y'all, what we say the LTV is for a conventional loan? 80%, which means you must put 20% down. However, y'all, could you potentially get a conventional loan and they give you 90% or maybe even 95%? Yes, they can do that. However, if they loan you more than 80%, then you will have to pay and buy private mortgage insurance, y'all, PMI. And I will tell you, it's not cheap. Y'all, this could be very expensive, quite frankly. Not could be, it is. And what's even worse, y'all, obviously the cost of the insurance is, y'all, depends on the loan amount. Y'all, there's a lot of variables there, so there's really no way to be able to say here's what it costs exactly, and it's not even important for test purposes. But y'all, I will tell you, y'all, I would say for the typical loan in our market, y'all, mortgage insurance anywhere from say $120 a month, $150 a month. Y'all, it could be a lot more, could be less, y'all, depending on the loan amount. But I'm just saying a typical amount is anywhere $120, maybe $150 per month. Y'all, and that's tacked on to your house payment. That's a lot of money. And not one penny of that $120 or so per month, none of that goes towards paying off the house. Doesn't pay down the principal. It's not applied towards interest. Y'all, that's just money down the drain. It is not tax deductible. Y'all, it is just money down the drain. Y'all, so that's why, y'all, this is expensive if you do get mortgage insurance. Well, again, if you're getting a conventional loan and you can't or don't have 20% to put down, y'all, you're going to be paying mortgage insurance on top of the loan expense, what it costs to borrow the money. But now here's the good news with these conventional loans. Y'all, once you've made enough payments, or maybe the house has actually appreciated in value to the point where you can now show that you now have 20% equity in the property. Y'all, once you can show you have 20% equity, y'all, now you can request the lender to drop the mortgage insurance. And then you don't have to continue paying for that. But you got to be able to show and perhaps even prove you have 20% equity. How do you prove that? Banks have AVMs, these automated valuation models, where they can look online and say, well, roughly we think your house is worth $100,000. You only owe $75,000, so that's 25% equity right there. So yeah, we'll agree to drop the insurance. However, if it's real close, or maybe the lender's not comfortable at all that you have 20%, then they may require you to have an appraisal done. And if the appraisal shows that you have 20% equity, then they'll drop the PMI. But if you don't ask them to drop the PMI, they don't have to, and I'd be shocked if they did. In fact, I'd tell you they're not. They're going to continue to charge it. But once you have 22% equity, now the lender must drop the PMI, whether the buyer asks to drop it or not. It doesn't matter. So the numbers I want you to remember here: once you can show 20% equity, you can now request the PMI be dropped. If we don't request it, maybe because we forgot about it, didn't think about it, whatever, once there's 22% equity, now the lender must drop the PMI. And then at least now you're not paying that with a conventional loan. Okay? Good stuff here. Equity, we were just talking about that, but that's the good stuff. That's the difference between what the property is worth and how much you still owe, right? So if the property's worth $200,000, but you still owe $100,000, that means you have 50% equity in the house, right? It's worth $200,000. You owe $100,000. So if you subtract $100 from $200, that means you have $100,000 in equity. This is where wealth building comes into play. The more equity you have, the more wealth you're building. Real estate has always been and will probably always be the number one wealth building tool in the world, probably. But if you think about it, most of the wealthiest people around the world, what is it that they all own, and own a lot of it? Real estate. That's why this is such an awesome business to be in. Awesome business. All right, that's what equity is. Now we got to take a look at qualifying the buyer. Now, honestly, this is one area that I've even debated, argued with the Real Estate Commission a good bit myself. Because, first of all, should you be trying to qualify the buyer? No. That is not your role. That is not your job. Then my question to the commission, then why do I need to know how to qualify the buyer? If I don't know how, then I won't be tempted to do something I'm not supposed to do, right? But anyway, we gotta know. But this is actually really good information. Not only, you can still in some ways assist your client here, and we'll talk about it here in a second, but it would be very helpful to you to understand this kind of stuff, okay? Now, how do we qualify the buyer? And look, this is not all necessarily written in stone, okay? It doesn't mean that some of the numbers we're getting ready to look at can't vary a little bit from time to time and for certain reasons. But the first thing we got to look at is this PITI. You hear that all the time. So when you make your house payment each month, typically that's considered your PITI payment. If you're not familiar with PITI and you don't know what that stands for, make sure you do. Memorize it. And you see that stands for principal, interest, taxes, and insurance. So there's 4 things that make up the total payment that you're making every month. So if you're paying $1,000 a month in house payment, that means part of that $1,000 going towards principal. Y'all, the principal is what's actually paying down what you owe. The interest is the cost to borrow the money, right? So part of that $1,000 going towards the interest. Taxes, y'all talking about property taxes, because you have to pay property taxes. And y'all, what they'll typically do is, y'all say your property taxes are $1,200 a year. Well, if you broke that down to how much would it be per month, then that would be $100 per month. Well, the lender wants to make sure you pay these property taxes. They also want to make sure you pay your hazard insurance. Y'all, if you have a house, you got to have insurance. You got to insure it. So what they'll do, y'all, they'll take both the taxes, whatever that cost would be, and what the insurance or the cost of that would be, divide it by 12 to come up with how much would it cost per month to pay for the insurance and property taxes. And then that is also added into your payment. So in essence, you're paying your property taxes and your homeowner's insurance to the lender. Y'all, the lender will set up what we call an escrow account. And the taxes and insurance portion of your payment every month goes into the escrow account. Y'all, the reason it has to be in escrow is because, y'all, this is your money. This is not money that belongs to the lender. It is your money, but they're collecting it from you. And then when the tax bill comes out at the end of the year, then the lender will pay your property taxes out of your escrow account. Same thing when your homeowner's insurance is due. Then the lender will pay this on your behalf out of your escrow account. Y'all, and I will tell you, for most people, this is a very good idea. Y'all, if the lender didn't do this, y'all, there'd be so many people that, y'all, they wouldn't have the money at the end of the year to pay it. Because we cannot, as y'all Americans, we're about the worst probably in the world when it comes to saving money. Y'all, it's like we can't do it. Y'all, if I've got a savings account over there, and especially if it starts to get any amount of money in it, y'all, it's like I can't stand it. I got to go buy something with it just to make myself feel better. Y'all, we cannot save money. So here we get to the end of the year and we owe $800 in homeowner's insurance, $1,200 in property taxes. That's an extra $2,000. And I don't have it. Now good chance you're going to lose the house. So the lender's really trying to help you out here is what they're doing with this PITI payment. So y'all just make sure you understand what PITI is. Now, when it comes to qualifying the buyer, y'all, it says your PITI payment, y'all, whatever that payment would be after all the four of those components are added up, it cannot exceed 28% of your gross monthly income. Cannot exceed 28% of your gross monthly income. Well, let's look at this. Y'all, first of all, now notice it says monthly income, gross monthly. Y'all, so what's a typical, what would be a good income, average income for a lot of people? Y'all, obviously that's going to vary. I don't even know if there's an answer for that question. So we're just going to make something up here. And let's just say this buyer makes $5,000. Y'all, I'm going to try to just write something on here. Y'all, they make $5,000 a month. Well, what is 28% of 5,000? Well, let's see. 5,000 times 28% is $1,400. So I know the most my PITI payment can be is $1,400. That's the most I can afford per month. Y'all, based on that step alone. Y'all, and we're not going to go any deeper than this, but just a point I want to make here. Y'all, obviously, if I have a financial calculator, which we don't have, we're not using that, we're not You don't need to know this for test purposes. I'm just pointing this out for real world purposes. But if I have a financial calculator and I know the most you can pay in a house payment, PITI, is $1,400 a month, y'all, and I know roughly what the interest rates are right now, y'all, I can now figure out how much this borrower can actually borrow. You know, how much could they potentially qualify for, okay? So, y'all, if I know what the payment can be, then I can figure out the rest of it. But that's the first step. Now, I will also tell you, if the buyer has no other debt, they don't owe any other money from anywhere, then that's all. Then that's it. That's all you got to worry about. We know they can borrow money up to $1,400 a month in payments. But if you have any other debt, y'all, now we got to take a look at this another step where now, y'all, we got to figure out, well, what else do you owe? Well, y'all, a lot of people, y'all, I'm just going to write some stuff here, might have a car payment. Y'all, that varies, and quite frankly, it's unbelievable to me what some people are paying in a car payment. But y'all, let's say $500. Y'all, again, whatever it would be, that's the number you would want to use. Maybe they have a credit card payment. And y'all, and I will tell you, if you have credit card debt, y'all, the way they're going to figure out that payment, y'all, is, y'all, they're going to go by what does the credit card company say your minimum payment would be, okay? So, y'all, let's say the minimum payment is $75. Y'all, again, I'm just making stuff up. Y'all, maybe you've got a student loan. Hello. And y'all, and I have no idea what that is. Y'all, feel sorry if anybody's got one, but yeah, I don't know what those are. But y'all, let's just say we're paying $100 a month on student loans. So if I add all this up, that'd be $675. So, so what are we going to do with this? What? Because it said, y'all, if you look at that third bullet, it says your PITI payment plus all other debt cannot exceed X percent. Y'all, and you see that those percentages vary based on the type of loan you're getting. So anyway, y'all, let's take a look. So how's that going to work? Well, let's see. Well, if you get a conventional loan, y'all, it says your PITI payment plus all other debt cannot exceed 36%. Well, what is 36% of this? So if we're making 5,000, let me get my calculator, times 36%, y'all, that's 1,800. Then minus the 675, y'all. So you're around what, 1125 or something like that. But y'all, I'm not going to get any deeper than that because I don't want to try to confuse you. But here's what I want really to understand. Y'all, and by the way, these percentages, this 36% conventional, 43 for FHA, y'all, I don't know that that's a big deal for test purposes. Y'all, that's just information I'm providing to you. But that's pretty much what these different loans are looking at. But y'all, here's what my concern would be. Y'all, if you look, in fact, let's just do it this way. We know if you're doing a conventional loan, your PITI payment plus all other debt would be $1,800 a month. Okay? Y'all, 36% of 5,000 is $1,800. FHA, y'all, let's look at that because I will tell you FHA is probably the most common. So if you take the 5,000 times the 43%, y'all, that's $2,150. Okay? So you're allowed to pay up to $2,150 in house payment with an FHA loan, and assuming your income is $5,000 a month. Well, So, y'all, let me just write that down. So if I take the 5,000 minus 2,150, y'all, what does that give me? 5,000 minus 2,150 is 2,850. Y'all, that's what you got left over at the end of the month. But here's the other thing you better keep in mind. And this is what really bugs me about lenders. Anyway, I'm just going to show it to you. So you got $2,850 left after your house payment. Y'all, that's all you got left for the rest of the month. Well, guess what? Another big expense that has not come out of this yet. Y'all, your taxes. Y'all, this is gross. They're basing this on gross income. So they're basically telling you what you can afford based on amount of money that you'll never actually receive. Because y'all, you haven't paid income taxes. Y'all, most people are probably around 30, 32, 33%, something like that in taxes. So y'all, let's just say 30% of 5,000 times 30%, y'all, is 1,500. So you're paying roughly, y'all, let's just say you're only paying 1,000 in taxes. So now we're down to 1,850. Y'all, and then out of that, that's what you're going to be buying your groceries with. You're paying your light bill, the babysitter. And we never can figure out why there's never any money left over at the end of the day. Y'all, I'm just telling y'all, if you ever borrow what the bank says you can afford, you're in trouble. You're in big, big trouble. Y'all, if I can just help you out, don't worry, this is not even for test purposes, not at all. But y'all, if you ever want to get ahead financially, then y'all, in my opinion, y'all, your total debt, car, house, credit card, everything, y'all, I would keep that under 25%. Of whatever your gross income is. Y'all, but when they're talking about you can afford 36, 41, 43%, you can be that much in debt, y'all, you're never going to recover from that. That's insanity. Y'all, don't do it. Just don't do it. All right, y'all, enough of that. But so again, now don't be trying to qualify buyers. Now, a lot of times what I will do, but I do this for myself, y'all, I may ask buyers if they're willing to, y'all, assuming they're my client, and I got to keep all this information confidential anyway. Y'all, I will run some of these numbers. Y'all, because one, I want to make sure I'm not wasting their time, and I certainly want to make sure they're not wasting my time. You know, buyer, what do you make per month? Roughly. I mean, what is your gross income? And then what else do you owe money on? Do you have a car payment? Do you have student loans? Do you have credit cards? Do you have a boat payment? Yeah, whatever it is. Y'all, and a lot of times I right off the bat I say, you know what? You're not going to be able to get a loan. You're not going to qualify. And we ain't even got into what the good grief, my mind just went totally blank. But anyway, y'all, there's a lot more that goes into y'all credit score. That's what I was trying to think of. We ain't even got into the credit score. But y'all, there's a lot that goes into the decision of whether you can borrow the money or not, or get the loan or not. It's just that this is one piece of it. Okay? All right, moving on from there. Y'all, then they talk about this loan application procedure, and y'all, and I'm not going to spend a whole lot of time here. Y'all, if you never applied for a loan before, y'all, you fill out an application and voila, go from there. Y'all, that's all they're talking about there. But then, y'all, to finish up on these general concepts, y'all, we talk about qualifying the title. You know, obviously, if you're going to borrow money to buy a house, then we have to qualify the title. You know, we got to know who owns the property, and then can that person actually convey or sell the property. And to do that, we got to qualify the title. Who does that? That's going to be the attorney job. Or at least, well, let me back up. It depends on what state you live in, okay? But in a lot of states, it's required to be done by an attorney. Some states allow maybe a title company to do it. So again, just make sure you know what your state law, your requirements are. But anyway, so somebody's got to qualify the title. And so what does that mean? Well, one, we got to make sure the homeowner or property owner has marketable title. Marketable title, in fact, let me just take it a step further. They have to prove that the seller has both marketable title and good title. Got to have both. Now, what is good title? Well, first of all, there's nothing gooder than good. Good title is as good as it gets, all right? But good title is proof of ownership. That means you actually own it. It's yours. Obviously, if you don't have good title, that means you don't own it. Therefore, you can't sell it or convey it. But not only do we have to make sure that this person actually owns the property, we also want to make sure that they can actually sell the property. That's marketable title. Are they able to sell or convey to someone else? So if we know we have both good and marketable title, we're in good shape. And that's what the title company or attorney, whoever is doing the title work, will be able to ascertain. If there's any liens that are currently on the property, like a current mortgage or whatever, but any liens, those have to be identified and have to be removed by closing. And then obviously if there's any covenants and restrictions that would pertain to this property, the neighborhood, then obviously that's going to be a big part of it as well. And that will be provided also. Okie doke.